Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello my dear CA Inter students who are writing exam and whose attempt is in May 25, September 25 or Jan 26. Here is Shivateja from Indigolearn to present you a very interesting and wonderful video related to CA Inter income tax amendments which are applicable for May 25, September 25 and Jan 26 attempt. There would be two categories of student. Category number 1 who is preparing for the first time in May 25 attempt. Second category are those who already wrote the exam and they are waiting for the results and they want to learn some more amendments. So any category you belong to, you can blindly go ahead and watch this amendments video which I am going to discuss next. And let me tell you very confidently, my dear friends, if you already purchased the classes, there is no requirement for you to buy the classes once again. But just watch this amendments video, your job will be done. Your old classes, wherever you have purchased, whatever you have done. If you already spent money, don't waste money again. Just watch the amendments video, your job will be done for May 25, September 25, Jan 26. And if you are yet to take your lectures, you can go ahead and happily purchase the amendment lectures. And at Indigolearn, we already updated all our videos for the latest attempt of May 25, September 25, Jan 26. And for those who already purchased anywhere, no problem. Just watch this amendments video. Your job will be done. You will be fully updated, fully amended for your examination. So why delay? Let's start with the amendments of CA Inter income tax for May 25, September 25 and Jan 26 amendments. Let's get ready, my dear friends. So for September 25, May 25 and Jan 26 attempt, whichever any of these three attempts, whichever attempt you belong to, this is the video for you to watch, which is mandatory to complete CA Inter income tax amendments. Get ready guys, let's start the show. Come on my dear students, let's look at the important amendments for May 25, September 25 and Jan 26 attempts. Now first and foremost important point you need to listen before I continue further is that, my dear friends, for your attempt, the amendments are applicable because you need to learn the amendments of Finance Act 2024. Please keep in mind, Finance Act 2025 is not applicable for the exam, but for May 25, September 25 and Jan 26 attempt, the Finance Act that is applicable is Finance Act 2024. So let's look at all the interesting amendments of Finance Act 2024, my dear students. Now, one interesting point before I continue further. That interesting point goes like this. That is, my dear friends, please understand that when you are writing your exam, in these three attempts, what you have to keep in mind is that for your exam, previous year will be 24-25. Come on, what's the previous year? Previous year will be 24-25 and assessment year will be 25-26. So for your examination, previous year will be 24-25, assessment year will be 25-26. Now let's deep dive into what are the important amendments given by Finance Act 2024. Other than these amendments, rest all content, whatever you already learned, holds good. Don't worry about it. Come on, see that. Let's look at that, my dear friends. CA Inter income tax amendments by Finance Act 2024. Applicable for what? May 25, September 25 and Jan 26 attempts. See now, first point. Upward revision of slab rates under default tax regime under section 115 BAC. That means what? In normal tax rates, there is no change at all. That means that 2.5 lakhs, 3 lakhs, 5 lakh, normal, senior, super senior, all that is same. There is no change in that at all. Now what we are trying to tell you is that there is only amendment in default tax regime section 115 BAC. I am sure you all know that. What is the default tax regime is 115 BAC only. If you want to opt out of default tax regime, you can opt out of default tax regime. But the basic tax rates are 115 BAC only. But if you want to opt out, you can apply that normal slab rates which are given by the Budget Finance Act, where we have got three categories: normal, senior, super senior. What is the normal category? 2.5 lakhs nil, 2.5 to 5 lakh 5%, 5 to 10 20%, above 10 30%. Senior up to 3 lakh nil, 3 to 5 5%, 5 to 10 20%, above 10 30%. Super senior category up to 5 lakhs nil, 5 to 10 20%, above 10 30%. Like that, we have got three interesting categories when we talk about the other than default tax regime. But what is Generally applicable is default tax in section 115 BAC. And students generally keep asking me a question, sir, in exam when a question comes, should I solve the answer as per default or should I solve the answer as per optional? One point I always tell the students is that if question is silent, you have to do both. I repeat again, if question is silent, you have to do both default as well as optional. If question specifically gives you solve as per default, then solve as per default. If question specifies the person has shifted out of default tax regime, then go for the normal slab rates of optional tax regime, where you have category of normal, senior, super senior. Are you getting clarity? But in default tax regime 115 BAC, there is no concept of in default tax regime of 115 BAC, there is no concept of normal, senior, super senior. We have slab rates, but it is standardized for normal also, senior also, super senior also. Now see what is the change. For assessment year 24-25, the answer was up to 3 lakhs nil, 3 to 6 lakhs 5%, 6 to 9 10%, 9 to 12 15%, 12 to 15 10 20%, above 15 lakhs it was 30%. So these were the slab rates that were existing for the previous attempt. Previous attempt, when I say previous attempt, when I am saying I am referring to May 24, September 24, Jan 25. But for May 25, this is not the answer. For May 25, September 25, Jan 26, the answer is up to 3 lakhs, it is nil, it is the same. Next category is 3 lakhs to 7 lakhs. This is important. Earlier it was 3 lakhs to 6 lakhs, but now that has become 3 lakhs to 7 lakhs. All 5%, 10%, everything is same. But it is no more 3 lakhs to 6 lakhs, it is 3 lakhs to 7 lakhs. So from 3 lakhs to 7 lakhs, it is 5%. 7 lakhs to 10 lakhs, 10%. 10 lakhs to 12 lakhs, here it is only 2 lakhs limit here. 10 lakhs to 12 lakhs, 15%. 12 to 15, 20%. Above 15 lakhs, 30%. Rest all story remains the same. Are you getting clarity? So the only amendment in 115 BAC is that earlier it was 3 lakhs to 6 lakh 5%, but now the answer is 3 lakhs to 7 lakhs 5%, 7 to 10 10%, 10 to 12 15%, 12 to 15 20%, above 15 lakhs 30%. So that's the tax rates given by default tax regime under section 115 BAC. Next point. Let me look at the next interesting amendment, my dear friends. Amendment to section 222. We know that 222 talks about a concept known as deemed dividends. Don't worry, this PDF also will add it to the description box. You can download from there, no problem. Come on, 222. We know that we have got 5 interesting points of deemed dividend. 222 A, B, C, D, E. What is 222 A? Release of assets to any shareholder. 222 B, issue of debentures to any shareholder or bonus shares to preference shareholder. 222 C, distribution of assets on liquidation. 222 D, distribution on account of reduction of share capital. And 222 E, we know very, very important point, any loan or advance given to a shareholder who is holding, what, my dear friends, 10% or more. And this section is applicable only to a company in which public are not substantially interested. It is giving loan or advance to a shareholder holding 10% or more, or to a concern in which that shareholder has got substantial interest, or to any other person for the benefit of such shareholder. Already we discussed this point in section 222E. But now there is one latest point, a new amendment which has brought in other sources topic, section 222F. Now what is this section 222F? This section 222F specifies that any amount received by the shareholder on account of buyback of shares, that is also regarded as deemed dividend and taxable in the hands of shareholder under the head income from other sources. Previously, what was the point? There was a point known as section 46A and section 115QA. Section 115QA specifies that whenever there is a distribution of amount by the company to shareholder on account of buyback of share, company was required to pay tax at the rate of 20% under section 115QA. But with effect from 1st October 2024, I repeat again, with effect from 1st October 2024, my dear friends, with effect from 1st October 2024, this point has been modified where they have specified that henceforth Any amount received by the shareholder on account of buyback of shares will be taxable in the hands of shareholder as deemed dividend under section 222F. You might get one doubt. Sir, what if 200 rupees is received on account of buyback, but at the time of purchase of shares, 50 rupees would have been paid at the time of purchase of shares? This entire 200 will be taxable in the hands of shareholder as deemed dividend under section 222F. And that 50 rupees what is paid at the time of purchase, that will become a capital loss. Either it could be short-term capital loss or it could be long-term capital loss. If it is long-term capital loss, we will set off only with long-term capital gain. And if it is short-term capital loss, we will set off with both short-term and long-term. See now, with effect from 1st October 2024, buyback payment will be taxable in the hands of shareholder and the same will not be taxable under 115 QA. But this amendment is with effect from 1st October 2024. So you should remember the old point also, new point also. So up to 30th September, who will be taxable? Company will be taxable. But with effect from 1st October, who will be taxable will be shareholder will be taxable. It will be regarded as deemed dividend in the hands of shareholder as per section 222F, clause F. For the purpose of this, subclause F has been inserted in section 222. And after this amendment, money received by a shareholder on account of buyback of shares will be treated as deemed dividend and consequently it will be taxable under the head income from other sources. No deduction will be allowed from such deemed dividend. I already told this point, you cannot reduce any expenses from this. And the following points may be noted. Number 1, amount received by the shareholder on account of buyback will be deemed as dividend under section 222F regardless of quantum of accumulated profits of distributing company. That means irrespective of accumulated profits. Why this point is important? Because in 222 A, B, C, D, E, everywhere the concept of deemed dividend is only to the extent of accumulated profits. But 222F specifies that irrespective of accumulated profits, whatever amount is received by the shareholder on account of buyback of shares, that will straightaway be regarded as deemed dividend. Next slide. The aforesaid amendment shall apply to any buyback of shares that takes place on or after 1st October 2024. I already told you this point, an important point, my dear friends. With effect from 1st October 2024, this point is made applicable. Are we clear with that, everybody? Exactly. Very, very important point. Very, very important amendment. High possibility that a question may trigger in the examination. Next amendment. Increase in standard deduction under default tax regime, section 16(1)(a). We know that in case of salary, my dear friends, we all know that there are 3 interesting deductions. 16(1)(a) standard deduction, 16(2) entertainment allowance, 16(3) professional tax. 16(2) and 16(3) is allowed both under default tax regime and wait a second. 16(2) and 16(3) is allowed only under optional tax regime, whereas 16(1)(a) is allowed both under default tax regime and under optional tax regime. And earlier, the amount of standard deduction was 50,000. But now there is an important amendment in this concept where the 50,000 limit is enhanced to 75,000, provided you are paying tax under default tax regime. So what is the answer now? If you are paying tax under default tax regime, the standard deduction will be 75,000. If you are paying tax under optional tax regime, the standard deduction will be 50,000 only. This is a very, very important amendment. Please do keep in mind while solving the questions. In case of default tax regime, standard deduction for salary computation is 75,000. In case of optional tax regime, standard deduction for computation of salary income will be 50,000. The logic why they increased only in default tax regime, because in default tax regime we will not get lot of deductions. That is why the tax rates are different. And I always keep telling during my lectures also, students generally keep asking me, sir, is default good or optional good? My always answer will be, it depends. It depends upon the quantum of deductions what you have. Based on that, you take a call which is better for you. And in exam, if question is silent, solve as per default and optional. If question specifically gives default, solve as per default. If question says he has shifted out of default, then solve as per that. shifted out of default, or you use the word optional, the meaning is same. See now. Standard deduction under 16(1) has been increased from 50,000 to 75,000. However, enhanced deduction is applicable only in case of salaried employee who pays tax under default tax regime. For an employee who has opted for a regular tax regime by exercising option under 115 BAC 6, that means he has shifted out of default tax regime, standard deduction will remain 50,000 only. That means 75,000 will not apply. 75,000 standard deduction will come only and only if a person is paying tax under default tax regime. Very interesting amendment, friends. Next point. Let's now move to house property. I've gone sequentially. Salaries, house property, PGBP, capital gains, other sources. That order is what I've taken. Next point. Amendment to section 28. What is section 28? Chargeability section for PGBP. Now see what is amendment. Explanation 3 has been inserted with effect from assessment year 25-26. I already told you for your attempt of May 25, September 25, Jan 26, the relevant previous year will be 24-25, relevant assessment year will be 25-26. To clarify that, any income from letting out of residential house or a part of the house, any income from what? Letting out of residential house or part of the house shall not be chargeable under PGBP and shall be chargeable to tax under the head income from house property. So rental income from letting out of a residential property will not be taxable under PGBP. It will be taxable under house property only. The reason why this amendment has been brought, because there are a lot of people who what they are doing is they are giving residential properties on rent and showing that under business income, telling that my activity is business activity only. They are doing that. And once you do business activity, what will you do is all expenses will reduce. But in house property, we all know that we get only two deduction. Number one, 24A standard deduction rate of 30% of NAV, 24B interest on borrowed capital. We all know this concept. That is where they brought the amendment telling that income from letting out of residential house will be taxed under house property only, but not PGBP. Next. The new explanation is applicable only in case of residential house. It is not applicable to a commercial property. That means for commercial property, this concept will not apply. If this concept will not apply, what is the meaning? If you are in the business of giving properties on rent, show under PGBP. If you are not in the business of giving properties on rent, show under house property. But this story is only in case of commercial property. If it's a residential property, whether you are in business of giving properties on rent or not in the business of giving properties on rent, rental income will not be taxed under PGBP. It will be taxed under house property only. Next amendment. Increase in deduction pertaining to employer's contribution to NPS. We all know that there is a concept of employer contribution to NPS, National Pension Scheme. Simple amendment actually with effect from 25-26. Earlier the deduction was maximum 10% of salary, but now they changed it to 14% of salary. A very small interesting amendment. During our lectures, we prepared one table of section 36 other deductions and we wrote all the points there. And for employer contribution to NPS, this 10% has now become 14% with effect from assessment year 25-26. Next point. See this. Disallowance of settlement amounts being paid to settle contraventions. Section 37. We all know that Section 37 deals with general deduction where we don't have any specific point but we have got conditions. If the conditions are satisfied, deduction is allowed. Number 1. Expenditure is not covered in 30-36. It is incurred wholly exclusively for the purpose of business. It is incurred during previous year. It is not capital in nature. It is not personal in nature. It is exclusive income for business purpose. Expenditure is not for the purpose of any offense prohibited by any law. Now a new point has been brought in this. Please see that. Settlement amounts. What is that word? Settlements. For example, we have done some default in income tax or GST. We have got into some scheme like GST settlement scheme, Vivad Se Vishwas scheme and done the settlement and paid the amount. Settlements amounts are incurred due to infraction of law and relate to contravention, etc. Such expenditure pertaining to settlement amount should not be allowed as business expense. To clarify this proposition, explanation 3 has been amended to clarify that expenditure incurred by an assessee for any purpose which is offence or prohibited by law shall include any expenditure incurred by assessee to settle proceedings initiated in relation to contravention and renewal of a timing in force. So there is a contravention of law, and to escape that contravention of law, you have done some settlement and you paid that settlement amount. That settlement amount shall also be disallowed. So this is an interesting amendment in section 37. Very important point, my dear friends. Next point. Section 40B, an interesting amendment. What is this point, my dear friends? Section, come on. Section 40B. Section 40B talks about disallowance of remuneration payable by firm to partner. We all know that whenever a firm is paying to partner, interest can be paid to any partner and maximum is 12%. But whereas salary can be paid only to a working partner, and salary can be paid only within the limits given by the law. And what are the limits? Limits are based on book profit. How do we compute book profit? Methodology is same, what you already learned. Net profit as per P&L account, plus or minus all adjustment. We will add excess interest debited to P&L account. We will add remuneration to partners debited to P&L account. The balance what we get is called book profit. On this book profit, first 3 lakhs we will take 1.5 lakh or 90% of book profit, whichever is higher. And balance will take 60% of book profit. Now these limits are very old limits. That is why in the recent Finance Act 2024, these limits have been upgraded. Now what is that they have done? What is the limits? On first 6 lakhs. Earlier what was the point? First 3 lakhs. On first 6 lakhs or in case of loss, 3 lakhs or 90% of book profit, whichever is higher. And the balance it is 60%. Friends, the small change what has been done here you have to observe very clearly. The small change what they have done very clearly here is that previously what was the answer? On first 3 lakhs, 1.5 lakh or 90%, whichever is higher. Balance it was 60%. Now what is the answer? On first 6 lakhs, 3 lakhs or 90% of book profit, whichever is higher. And balance, same answer, 60%. So that is an interesting amendment done in section 40B. So with this, we are done till amendments up to the point of PGBP. Now let's look at some very important amendments in capital gains. Come on friends, now that we are done till the point of PGBP, let's look at the next point of capital gains. Something very important, and there are some wonderful amendments in this topic. Very important amendments. So let's watch out very carefully. See that now. Transfer of capital asset by gift or will. This is a very small amendment. The only thing what they have done is simple answer. Section 47, we know that transactions which are not regarded as transfer. That means for these transactions, there is no question of capital gains tax. A small clarification has been given that this concept of transfer of capital asset by gift or will is applicable only when it is given by an individual or HUF, because that is where there is a concept of natural love and affection of gift. See that. Section 47.3 has been amended with effect from assessment year 25-26 to provide that exemption will be available only in case of transfer of capital asset by gift, will or irrevocable trust. By whom? Individual or HUF. In other words, if capital asset is transferred by other than individual or HUF by gift, it will be chargeable to tax. I am sure we are getting clarity. So the small thing is that where there is a concept called transaction not regarded as transfer, where there is a point known as transfer of capital asset by way of gift or will, the extra one word they added there, transfer of capital asset by way of gift or will or irrevocable trust by an individual or HUF, because that is where there is a concept of gift, right? Very logical amendment actually. Next point. Interesting point. Section 242A, definition of long-term capital asset. I'll simplify, my dear friends. We all know that there are 3 categories to determine long-term or short-term. More than 12 months, more than 24 months, more than 36 months. 12 months is in case of 4 category. Listed securities, units of UTI, units of equity-oriented mutual fund, zero coupon bonds. These are the 4 points in 12 months. In 24 months, we have got land and building. Number 2, unlisted shares. And all other category will come under 36 months. Now what they have done is this 24 months and 36 months logic, they combine together. That means henceforth there is no concept of there is no concept of 12, 24, 36. There is only concept of 12 and 24. But when I say henceforth, there is a point to be noted. That is, with effect from 23rd July 2024. Now, why is this date 23rd July 2024 important? Because the budget has come in July 2024 and the amendments of capital gains are made applicable with effect from 23rd July 2024. That means if asset is transferred prior to 23rd July 2024, there is a concept of 12 months, 24 months, 36 months. But if asset is transferred on or after 23rd July 2024, there are only two categories, 12 months, 24 months. 12 months, what is covered? Listed securities, units of UTI, units of equity oriented mutual fund, zero coupon bond. Other than this four, straight away the answer is 24 months. That means with effect from 23rd July 2024, there is no category called 36 months. Student might ask me one doubt. Sir, should I remember only 12 and 24 now? No. For your exam, for May 25, September 25, Jan 26, what is the previous year? 24, 25. Assessment year, 25, 26. Now when previous year is 24, 25, it covers 1st April 24 to 31st March 25. So you should remember both. You should remember the concept of 12, 24, 36 also, 12 and 24 also. Both are relevant for you because if asset is transferred prior to 23rd July 2024, the concept is 12, 24, 36. If asset is transferred on or after 23rd July 2024, the concept is straight away 12 and 24. See next. After the amendment, there will only be two holding periods, 12 and 24. 12 what is covered? Listed securities, units of UTI, units of equity oriented mutual fund, zero coupon bond. And I am sure you have a clarity as to what is equity oriented mutual fund. And this amendment is with effect from 23rd July 2024. So if asset is transferred prior to 23rd July 2024, there are three categories. If asset is transferred on or after 23rd July 2024, there are only two categories, 12 months and 24 months. And these four, what is there in front of you are 12 months, which are highlighted. Other than these four, it is straight away 24 months. Next point. Indexation benefit, very, very important amendment. Most of you would have heard in TV, paper, ads, everywhere. Lot of ads have been given with respect to this. The concept is very simple. Henceforth, when I say henceforth, again the answer is 23rd July. Because for capital gains, amendments are effective from 23rd July. Prior to 23rd July 2024, for long-term capital gain, we all know that we apply the concept of indexation and the tax rate is straight away 20% as per section 112. In 112A, there is an amendment only for tax rate. But in 112, what is the tax rate? 20% with indexation benefits. But now the concept is, if an asset is transferred on or after 23rd July 2024, then for computation of long-term capital gain, we are not going to take any indexation benefit. That means the concept of indexation benefit has been removed for computation of long-term capital gain if asset is transferred on or after 23rd July 2024. And the rate of tax is going to be 12.5% only, but not 20%. But you should remember both. See now, indexation benefit will not be available if an asset is transferred on or after 23rd July 2024. And the long-term capital gain will be calculated after deducting cost of acquisition and cost of improvement. But we are not going to reduce index cost of acquisition, index cost of improvement. That concept is gone. And the rate of tax is not 20%, it is just 12.5%. And there is no impact on other provisions. And while the benefit of indexation is no longer available for long-term capital asset transferred on or after July 23rd, other provisions relating to computation are unaffected. That means if asset is acquired prior to 1/4/2001, original cost or market value, Manjula, Jesha case law, all that is as it is. Previous order concept, everything is same. But the only difference is that if asset is transferred on or after 23rd July 2024, don't take indexation. Forget indexation for cost of acquisition, cost of improvement, no indexation. And the rate of tax is not 20%, the rate of tax is 12.5%. Are we clear till here? But one special point I'll tell now. What is the special point? See here. I'll explain first. Listen to me, focus on me, then focus on screen. What you have to focus on me is that, sir, let us say for example, if there is a capital asset which is transferred on or after 23rd July 2024, and the capital asset is land or building or both, then they gave a small benefit in the law. That small benefit what they gave is, you do the computation of capital gains without indexation, and what is the tax rate actually? 12.5%. Other side, you do computation of capital gains with indexation and compute tax at the rate of 20%. Check which one is beneficial, go for that benefit. That means you can either pay tax at 12.5% without indexation, or you can pay the tax at 20% with indexation. This benefit is only and only for land or building or both. And that too, this benefit is only and only for resident individual or HUF. And that too, this benefit is only and only in case where asset is acquired prior to 23rd July 2024 and it is transferred on or after 23rd July 2024. Let us say, for example, it is acquired also after 23rd July, transferred also after 23rd July 2024. Then straight away apply tax at 12.5% without indexation. This great benefit called 12.5 without indexation or 20% with indexation is only and only in case where it is land or building or both, which is acquired prior to 23rd July 2024, transferred on or after 23rd July 2024, and that too you are a resident individual or HUF. Then only this benefit will come. See the points. Focus. Generally, they are taxed at 12.5% without benefit if it takes place on or after 23rd July, and 20% if it takes place prior to 23rd July. However, in case given below, I clearly wrote, I wrote the language. Assessee has an option to pay tax under 20% with indexation or 2.5% without indexation. When transferor is a resident individual or HUF, capital gain arises on transfer of land or building or both, and it could be residential or commercial. It is just land or building or both. Next slide. Asset is acquired prior to July 23rd, 2024. It is transferred on or after 23rd July 2024. Then you have got two options. Option 1, you compute 12.5% without indexation. Option 2, you compute 20% with indexation, and check which one is beneficial for you. You can take that benefit. And this benefit is only in case of resident individual or HUF. No other person can get this. No other person can get this benefit. And the above provisions are applicable only if all these conditions are satisfied. But you see one line, above provisions are not applicable if capital gain arises on transfer of land or building or both prior to 23rd July. If it is prior to 23rd July, then directly compute without indexation and pay tax at 20%. Very, very interesting amendment. Very, very important. And mark my words, this will come in exam. This will come in exam. Next point. Amendment of section 50AA. Section 50AA is what? In case of market linked debentures, in case of units of specified mutual fund, the gain is deemed to be short term. That means even though they are long term, they are deemed to be short term only. Irrespective of period of holding, they are deemed to be short term. What is that? Number 1, come on, market linked debentures. Number 2, units of specified mutual fund acquired on or after 1st April 2023. Now a new point is added in that. That is, they are also covering unlisted debentures and unlisted bonds. Unlisted debentures and unlisted bonds, provided they are acquired on or after 23rd July 2024. All the amendments of capital gains are with effect from 23rd July 2024 only, my dear friends. Please note that point. Next line. Modification of rate of tax for long term and short term. Sir, 111A. 111A, earlier what was the rate? 15%. But now that 15% is changed to 20%. 112, 20% is changed to 12.5%. So so now the straight answer is long term, there is no concept of 20%, 10%, all gone. It is straight away 12.5%. And 111A short term, it was 15%, it has now become 20%. 112A, what is 112A? Long-term capital gain on sale of equity shares or units of equity-oriented mutual fund or units of business trust through recognized stock exchange on which STT is paid. Actually, it was taxed at the rate of 10% on amount exceeding 1 lakh. This point is still correct, provided the gain has arisen prior to 23rd July 2024. But if the capital gain has come on or after 23rd July 2024, then the rate of tax is 12.5% on amount exceeding 1,25,000. What was the answer before? 10% on amount exceeding 1 lakh. 10% on amount exceeding 1 lakh prior to 23rd July 2024. On or after 23rd July 2024, the answer is 12.5% on amount exceeding 1,25,000. Very, very important amendment, guys. So these are the very, 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 very important amendments with respect to capital gains. Something highly significant, high possibility that question may trigger in the examination. So please make a note of it. Are we clear with that? Next. Moving forward, now let's proceed to income from other sources. Amendments. Moving forward, my dear students, now let's look at the next point about income from other sources amendments. First one, 5627B. We know that you would have learned this. If you have already taken the coaching, you would have already learned this. Who are yet to take the coaching, feel happy, this section is gone. The point is, whenever there is a issue of shares by a company in which public are not substantially interested, they are giving shares to the shareholder, and if issue price is more than market value, the difference was taxable under income from other sources in the hands of shareholder. But this section has been removed. If you already learned this, then forget it. If you are yet to learn, then don't try to learn this. Happy? Wonderful. Next slide. Increase in standard deduction from family pension. First, our family pension, we all know that normal pension we tax in income from salaries, but family pension is taxable under head income from other sources. And in family pension, there is a deduction of 1/3 of the pension or 15,000, whichever is lower. But this 15,000 is now increased to 25,000. But the point to be noted is this benefit of 15,000 increased to 25,000 is applicable only and only if a person is paying tax under default tax regime. So now what is the concept then? If a person is paying tax under default tax regime, the deduction for family pension will be 1/3 of the pension or 25,000, whichever is lower. If he is not paying tax under default tax regime, the deduction for family pension will be 1/3 of pension or 15,000, whichever is lower. That means in default, this will be 25,000. In optional, it is 15,000. See the line. For assessment year 2025-26, standard deduction from family pension will be 25,000 or 1/3 of pension, whichever is lower. But this benefit is only if a person is paying tax under default tax regime and has opted for regular tax regime. It is still the same 1/3 of pension or 15,000, whichever is lower. Important point, this can come as an MCQ. We all know that MCQ multiple choice questions are important. Lot of times I am surprised when students try to mug up MCQs. That is nonsense. Never ever do that. MCQ is not something very different. It is just your concept which is presented to you and asked you in a different format. That's it. We cannot afford to leave it, my dear friends. MCQs are very scoring. Don't miss marks there. Next. ATG. ATG, we know that ATG talks about donations where we have got 4 categories: 100% without qualifying limit, 50% without qualifying limit, 100% with qualifying limit, 50% with qualifying limit. Now a small point, which is a small point, my dear friends, that is about National Development Fund. See that? Deduction in respect of donations to funds. In computing total income, any sum paid by the assessee in previous year as donations to the fund to be set up by the government, and central government had already set up the fund named as National Development Fund. Since it is already set up, my dear friends, for that also deduction is allowed. Simple answer. So in law, the word used is funded to be set up, but this is already set up. So there is a small clarification what they gave. That's it. Next, quoting of Aadhaar number, section 139AA, an important concept. For the purpose of application of PAN, for the purpose of filing income tax return, Aadhaar number quoting is mandatory. Previously, there was one point specifying as if a person is not having Aadhaar number, he can quote Aadhaar enrollment number, what is obtained at the time of making Aadhaar application. But that concept has been removed now. So now there is no concept of quoting Aadhaar enrollment number. You have to quote Aadhaar only. See that. Quote is Aadhaar in allotment of PAN, return of income. And if it does not have Aadhaar, enrollment number was allowed. Now what is the amendment? The provision permitting quoting of enrollment ID was introduced in 2017. Since then, based on publicly available data, Aadhaar coverage has expanded, encompassing most of India's population. And discontinuing the option to quote enrollment ID is essential to prevent potential duplication or misuse of PAN number. So consequently, provisions of quoting Aadhaar enrollment shall cease to apply from October 1st, 2024. So from October 1st, 2024, there is no concept of quoting Aadhaar enrollment number. You have to quote Aadhaar number only. And who has already obtained PAN based on Aadhaar enrollment number, then you have to update your PAN with Aadhaar number. Next. Moving forward, now it's time to talk about amendments in TDS, our favorite topic, interesting topic. And in TDS, all the amendments are with effect from 1st October 2024. So amendments what we are going to learn in TDS are with effect from 1st October 2024. That means up to 30th September, already what concept you learn, that is the answer. After September, this is the answer. Clear? Both you have to remember. No option. For May 25, September 25, Jan 26 attempt, you have to remember both. See them. 192, TDS on salary. Tax is deductible from employee's salary by the person responsible for paying salary payments. Deductors are required to consider all income tax provisions relating to computation of salary and corresponding tax. And if employer provides declaration of his income, employer should take that into account, not only salary but also other income and other TDS done. Now what is the amendment they have done? There is no provision to claim credit of TCS from the employer. Now amendment done is that with effect from 1st October 2024, it allows deductors to take TCS into account while computing the tax liability. TDS liability basically. So the point is very clear now. What employers will do is, they will estimate what is the total income of the employee, salary income of the employee, reduce whatever is the TDS, reduce whatever is the TCS. Earlier we were not reducing TCS. But with effect from 1st October 2024, TCS is also reduced. So from tax liability, reduce TDS, reduce TCS. From the balance figure, whatever is there, that will divide by 12, and every month employer keeps on deducting that as TDS from the employee's salary. This concept is given by section 192. Next point, 193. The scheme of 193, interest on securities, has been modified with effect from 1st October 2024 to provide that interest payable on floating rate savings bonds 2020. Interest payable on what? Floating rate savings bond 2020. Interest payable on floating rate savings bonds 2020 taxable or any other notified security of the government shall also be liable for TDS if the interest payable on securities exceeds 10,000 during financial year. Already we know that in 193 there is a point called for 8% savings bonds, it is 10,000 only. So the same 10,000 will apply even for floating rate savings bonds 2020 or any other notified security. So if it exceeds 10,000 in a year, then TDS will be applicable. And TDS rate already we know 10%. Next, 194 important section. 194 important section, TDS on buyback payments. Already I told you this point that with effect from 1st October, whenever there is a buyback and company is giving amount to the shareholders on account of buyback of shares, that amount will be taxed in the hands of shareholder as deemed dividend as per section 222F. So on that also TDS will apply. That means company is supposed to do TDS. After the amendment, money received by the shareholder on account of buyback will be treated as deemed dividend. It will be taxable under income from other sources. So automatically TDS also is supposed to be done. Are we clear with this point? Excellent. Next amendment in TDS, guys. 194C. 194C is TDS on contract payments. 194J is professional, technical, royalty, non-compete fees, director's remuneration other than salary. We know that, right? Exactly. 194C, what is the TDS rate? 1% if receiver is individual or HUF, 2% in other cases. We know that, right? And 194J, what is the TDS rate? For professional, it is 10%. For technical, it is 2%. Already we discussed that. Already we know this concept. What is the explanation they have done? Explanation to 194C defines what constitutes work for the purpose of 194C. As there is no explicit exclusion for assessees who are required to deduct tax under 194J, some deductors are applying 194C even when technically 194J is applicable. That means what clarification they have given is, if it is technical service, please apply 194J only, not 194C. Just because TDS rate is same, don't apply wrong section. That is what they are trying to tell. So to address this, explanation has been amended with effect from 1st October to explicitly state that any sum referred to in 194J, that is your technical service, does not fall within the definition of work for the purpose of TDS under 194C. That means once it is covered in 194J, then don't apply 194C. That is the point. So for something which is covered in 194J, 194C will not apply. Next point. Again related to TDS only. Reduction in TDS rates with effect from 1st October 2024. Already I told you, TDS amendments are with effect from 1st October 2024 only. But in capital gains, the effective date is 23rd July 2024. Don't confuse yourself. In different cases, the answer is different because this is an interim budget and final budget brought. In 2024, 2 budgets have come. That's the reason why all these changes are there. The date is, cutoff date is 23rd July 2024 for capital gains. But for TDS, it is 1st of October. See next. 194 DA, payment in respect of life insurance policy. It used to be 5% earlier, but now it is 2%. So it was 5% up to 30th September, but from 1st October it is 2%. You have to remember both. For May 25, September 25, Jan 26, you have to remember both, my dear friends. Next. 194G, 194H, both sections it is commission. It was 5%, it has now become 2%. Here also 5% has become 2%. That means up to 30th September it is 5%, from 1st October it is 2%. 194IB, payment of rent by individual or HUF who are not subject to audit. 5% was there before, but now it is 2%. Then finally, 194M, payment for professional, payment for contract by an individual or HUF where the amount is more than 50 lakhs. It was 5%, but now it is modified to 2% with effect from 1st of October 2024. So all this table I prepared in a simple manner so that you get a clarity of thought as to what was the earlier one, what is presently. But both are important for your exam because up to 30th September, 5% is the answer. From 1st October, 2% is the answer. Are we clear with that? Very good, very important. High possibility of an MCQ and high possibility of question coming in examination. Next. 194IA. Friends, what is 194IA, my dear friends? Purchase of immovable property for more than 50 lakhs, buyer is supposed to be treated at the rate of 1%. A small clarification they gave, that is something like this. Let us say there is one seller who is selling a property for 60 lakhs and there are 2 buyers, buyer A, buyer B. Buyer A is paying 30 lakhs, buyer B is paying 30 lakhs. Question is, will TDS apply? Earlier there was a confusion. Now the clarified answer is yes. As long as the consideration for the property is more than 50 lakhs, TDS will apply. If it is less than 50 lakhs, TDS will not apply. If it is 50 lakhs or more, TDS will definitely apply the rate of 1%. So don't see person wise. I repeat once again, very important line. Don't see person wise, see based on property. See that. 194IA provides that 1% TDS is to be done at the time of payment talk rate, whichever is higher, and 1% is on purchase consideration or stamp duty value, whichever is higher. And no deduction is made if the consideration for transfer and the stamp duty value both are less than 50 lakhs. Now what is the amendment? With effect from October, already I told you TDS amendments are from October only. Where there is more than one transferor, that there is more than one seller, consideration for calculating the limit shall be aggregate of amounts paid or payable by all the transferees to the transferor or all the transferor. That means all sellers, all buyers put together for the property, we will see that 50 lakhs limit. We will not see person wise. Example I already told you. One person X is selling to Y and Z for 60 lakhs. Y is paying 30, Z is paying 30. Still TDS will apply because for property it is 60 lakhs. Getting clarity, my dear friends? Very, very important point, guys. Beautiful point, important amendment. A small question can come in exam for 2 marks. So I've got 2-3 more interesting amendments in TDS that also I'll discuss and complete, my dear friends. Next. Time limit for filing correction statement for TDS and TCS quarterly statement. We know that TDS, TCS returns are to be filed on quarterly basis and it can be rectified or revised any number of times. There was no limit earlier, but now the amendment what they brought is that no correction statement, that means no revision, shall be made after expiry of 6 years. So much of time they gave, guys, so much of time they gave. Shall be after the expiry of 6 years from the end of financial year in which TDS or TCS quarterly statements are required to be delivered. So from there, 6 years from the end of financial year, we have got time to revise that TDS, TCS returns or statements. A small amendment, it may come in exam or may not come in exam. More for knowledge. Next point. TCS under section 206C1F. 206C1F, my dear friends, whenever there is a sale of motor vehicle for more than 10 lakh rupees, there is 1% TCS collected by seller. Already we know that, no, my dear friends? Exactly. A small amendment, more for knowledge. More for knowledge, you will only know why. Above provision has been amended with effect from Jan 1st, 2025 to levy TCS on any other luxury goods exceeding 10 lakh rupees as may be notified by the government. So far, nothing is notified. If something is notified where the sale value is more than 10 lakh rupees, then the seller will collect 1% as TCS from the buyer. So this is the interesting amendment in TDS and TCS. So with this, my dear friends, I am happy to share that we have discussed a lot of interesting amendments for May 25, September 25, Jan 26. Only these are the amendments which are applicable for CA Inter Income Tax. Already you have taken coaching somewhere else, already paid money for it, don't waste your money again. These are the extra amendments what you have to learn. Watch this video, your job is done. Solve some questions, your story is over. Any doubts, you would mention in your comment section, we'll be more than happy to reply. Or at Indigolearn, post on the forums, we'll be more than happy to reply. Don't worry at all, we are always there for your support. And those students who are yet to start afresh, you can happily purchase our latest amendment lectures and watch the new video itself. You do not take effort as to what was the old one, what is the new one. That effort you do not take. So this is the ultimate solution for May 25, September 25, Jan 26 attempt of CA Inter. And these are the amendments for CA Inter Income Tax, amendments made by Finance Act 2024. So with this, I conclude my session and lecture on amendments, my dear friends. I wish you all success. I wish you all the very best. Take care. See you soon. Any doubts, do comment in the comment section. We'll be more than happy to reply. Or the forums, we'll be more than happy to reply. All the very best. Do come out with flying colors. Any support, Indigolearn is always there for you. Indigolearn, students first. Thank you so much. Take care. Shiva Teja signing off. Bye-bye. Thank you.